Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're talking about ESPN and ESPN Plus after Disney's second quarter fiscal 2019 earnings results came out last week. So we're going to dive into some of the raw numbers there and then see what we learned from the earnings call. But before we do that, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. So as I mentioned at the top, Disney reported its second quarter fiscal 2019 financial results after the closing bell last Wednesday, May 8th. Quickly, the entertainment giant reported adjusted quarterly earnings of $1.61 per share, which topped our estimate by 2 cents. We should note that this marked a 13% year-over-year decline, so it beat estimates, but it was down year-over-year as it continues to spend a lot of money on its streaming TV future. Meanwhile, revenues popped 3% from the year-ago quarter to reach $14.92 billion, and this also surpassed our consensus mark. So top and bottom line beats for Disney, which is always a good sign. But before we dive into the rest of the report and take a look at Disney as a whole and ESPN and its streaming future, let's see kind of what happened in the lead up to the report, because some fun stuff happened before they actually reported that caused the stock price to surge. So shares of Disney were up over 22% in 2019. More specifically, Disney stock was up 15% before its earnings release after its April 11th Investor Day, when it detailed some of its plans for the new Disney Plus streaming service that it hopes to compete against Netflix, Amazon Prime, all those other services. This is now officially set to launch. You can go on, there's a Disney Plus website with a countdown page. You go on, that's set to launch on November 12th and cost $6.99 per month. For reference, Netflix Cadillac plan, its premium plan, currently charges $15.99 per month, and then Amazon Prime memberships cost $119 a year. So that's the reference point there. Much of what is going to be on the service and how it's going to look is kind of still up in the air at this point, but we do know is that there'll be Disney content, Pixar content, Star Wars content, Marvel content, National Geographic, and this will include new shows and movies as well as already released content. So that's the overview of Disney Plus, which after that April 11th Investor Day, the stock shot up. Seemed like kind of already priced in a little bit of what they anticipate this Disney Plus service to do for the company over the next year or so after it first launches in November of this year. So now I want to dive into the report and then get to the ESPN stuff. So parks and experiences and products. Disney last quarter kind of reshuffled how they're reporting their revenues into 4 units because streaming is going to be a big part of their future. So parks and resorts used to be its own thing. Now it's parks, experiences, and products. So that includes toys. That unit was up 5% to roughly $6.2 billion. And then meanwhile, its studio entertainment revenue, which remained the same category, that revenue fell 15% to $2.1 billion, but this isn't really shocking as its studio entertainment business is by far the most volatile. It makes sense if you think about it. It's based on movie release dates and how they can be totally different from year to year, and then it also depends on box office hits and flops. For instance, in the year-ago quarter, the Disney released Black Panther. It was a massive, massive hit. It was also still getting some money coming in from the last month or so of Star Wars The Last Jedi being in theaters, and then this current quarter, or the quarter they just reported, that was competing against Captain Marvel and no comparable Star Wars titles. So you can see why there's the 15% drop off in studio entertainment revenue, and that's something that Wall Street investors are going to know on a quarter to quarter basis, that business can really fluctuate wildly. But for our purposes today, we're much more concerned with the media networks division and its direct-to-consumer business, which is really just starting to come into kind of existence in the last year or so. So let's start with the media networks first, though, and that revenue came in roughly flat at $5.5 billion. Cable network revenue was up $2 billion, or up 2% to $3.7 billion. Broadcast revenue was down. And interestingly enough, operating income increased 2% as well. And this was due to a big increase at ESPN. ESPN is kind of the flagship of its media networks business, especially its cable networks sector of that media networks business. And the increase at ESPN was due, for the most part, to higher affiliate revenue, and that was then offset by programming costs and production costs and a decrease in advertising. And that's kind of been the story at ESPN for the last several years. They're charging more than ever for a cable package, but then less people are watching. Their production costs are going up, which means they're paying more for NFL rights, NBA rights, all the rights, because the live sports rights are continuing to go up, and they're seeing a decrease in advertising revenue because simply less people are watching. So, as I mentioned, ESPN, though, is still able to charge over $8 per subscriber, which is by far the most in the industry. The next closest is Yes Network at just over, or around $6.40 per month. And this is why Disney had to divest Fox's 22 regional sports networks as part of its massive $71.3 billion deal to acquire a lot of those big major Fox assets that are going to set it up for a bigger box office and streaming future. So yeah, as I mentioned, that's going to be the story you hear from ESPN for the foreseeable future. And this is why ESPN and Disney are spending so much money on that ESPN streaming service going forward. And I quickly want to just jump into some ESPN stats that the company gave on its Investors Day, because I think it's kind of important just to give a little context of just how big ESPN is. So Disney said that ESPN reaches nearly 200 million people per month across TV and digital in the U.S. alone. That's a lot of people. There's only 330 something million people in the United States, so reaching 200 million every month is a big deal. ESPN then also remains the top-rated cable network among men, a leader in this demographic for what they said was 13 straight years. It also ranks as the clear, this is also a little bit of their spin on these things, but in terms of the raw numbers, those are right. The clear number one in the global digital sports category for unique users and minutes consumed. And they said that's 44% higher than their closest competition. So some pretty big numbers for ESPN, even though its overall cable advertising dollars are down just because more and more people are cutting the cord. And most of those people might not have been watching ESPN in the first place. But now I want to jump into ESPN Plus and see what updates they gave us there. For those of you who aren't as familiar with this yet, which it's still a relatively new service, so you might not be, ESPN Plus launched in April of 2018 at $4.99 per month. They're running a promotion for $49.99 per year. And the firm will also make money from ads, because this is not just purely a subscription service, because sports in general lean themselves towards having ads because there are timeouts. Obviously, there are now TV timeouts that are specifically for ads. So you could see in the future maybe services like ESPN Plus or Amazon Prime, who's really jumping into live sports, maybe being able to charge people a little bit more to, instead of cutting to a commercial during a timeout or halftime, they give you some more content, or they would just show you the timeout or something like that. Because there is, sports fans are very fanatical often about their teams. They would love to see inside a huddle during a TV timeout instead of seeing some commercial for a razor they've seen a million times, and they might be willing to pay even more for that. And going forward, that subscription model is really going to be more powerful at the end of the day, most likely, than advertising. And we should also note that ESPN's premier content, that Monday Night Football, big-time NBA basketball, big-time college football and basketball, none of that's on ESPN Plus at the moment, because all of those deals are made with the knowledge that it would be on ESPN's TV platform. You can obviously watch all of that content if you have a cable subscription on ESPN's app, so you don't actually have to be watching it on cable, but you have to have a cable subscription to watch any of that content. So going forward, we could be years out from seeing a completely standalone ESPN platform that would allow users to have all of the content available on ESPN without having any type of cable package. But we'll see where that comes down the line. So instead, what ESPN Plus is doing for now is kind of trying to supplement their content. They have Major League Baseball, NHL games, boxing, some different college sports, lower level college sports, basically just not huge basketball and huge football. Is you'll find all types of college sports in there. UFC is going to be hugely important. They've spent a lot of money on soccer rights. They're doing a lot of stuff with Major League Soccer, Italian League Soccer, cricket, rugby, just anything besides their big Monday Night Football, NBA basketball, and college football and basketball is what they're trying to do. They're doing some unique shows as well. That's now where all of their 30 for 30 critically acclaimed documentaries live. So it's interesting, their model and approach for this now. And as I mentioned, UFC is kind of a big thing they're hoping is going to drive viewers to ESPN Plus. UFC is the Ultimate Fighting Championship. It's, for those of you who know, it's pretty much no hold bars, boxing, kickboxing, all mixed into one. It's become relatively popular in the United States over the last 5 years or so. And they landed a 5-year deal worth reportedly $1.5 billion for the UFC rights. And then they're going to be the exclusive pay-per-view home for a lot of these UFC fights on Saturday nights. So they've already seen that really driving subscriptions to ESPN Plus, because a lot of people, I mean, $5 a month is what some people pay for one cup of coffee a day. So ESPN Plus is not a service that many people, if they really want to watch the content, will hesitate to pay for. At the moment, ESPN has said its streaming service has more than 2 million paid subscribers already, and that's just over the last year. And then in their big Investors Day presentation, Walt Disney said that they expect they could get to between 8 million to 12 million paying subscribers on ESPN Plus by the end of fiscal 2024. So within the next 5 years, they think they could get to maybe 12 million paid subscribers, up from 2 million at the moment, which is not that lofty of a goal. So we could see that easily happening. They also noted that they expect ESPN Plus to have an annual operating loss of $650 million in fiscal 2019 and 2020. But they do see the service slowly becoming profitable, and they see that profitability by 2023. So they're really spending heavily on this to roll out now. They started it from scratch not too long ago, as they saw the streaming TV as the wave of the future, and they needed to get on board as soon as possible. So they're spending now for their long-term health of the company. So yeah, as we mentioned, they're expecting some big numbers there. It's up to 12 million people by 2024, and then profitability the year before that. And I want to kind of, this isn't speculative completely on the future of ESPN Plus, but some of it's kind of just talking about what they're going to do. So Disney clearly has a plan that ESPN Plus is going to be eventually a standalone ESPN service at some point when they're completely detached from cable. As I mentioned, it's not exactly sure when it's going to happen like that. And at this point, they've also said that they don't plan on bundling ESPN Plus with Disney Plus and Hulu, which they also own, anytime soon. But that could clearly change almost at any time when it seems like it's a good business move, because with all the different streaming services out there now, maybe bundling this ESPN Plus, Disney Plus, and Hulu would be a really easy way to attract people to their service. They're also getting into sports betting content, which is something that I've talked about on the show a lot. Bob Iger was asked to address that on this past earnings call. He didn't really go into any details, but that's because Disney's considered kind of a family company, and they don't want to get into that much about sports gambling content, but they already have it. They already have a couple shows about it. And this is just a little bit of a quote from Bob Iger on the conference call. He said, "We'll provide programming that will, I guess, be designed to enlighten people who are betting on sports. But that's as far as we would go. And I think you'll see more of it integrated into programming, but we just don't intend to go into the gambling business." So they're saying they're going to give you as much news and information and odds and all of that as possible about sports betting, but they're not going to be operating a betting service anytime soon. And this is also coming at a time when all four of the major North American professional sports leagues have partnered with casinos as official sponsors of the league, as that betting future slowly rolls out throughout the country on a state-by-state basis. The NFL is working with Caesars, the NBA, Major League Baseball, and NHL have partnerships with MGM. And now there's also even talk, because for a long time, the NFL rights have that's the content that they're talking about is going up in price, and it's driving operating costs lower. But ESPN and Disney are committed to the NFL as their future. There's even talks now, and Bob Iger addressed it because there's some rumors floating around that ESPN is going to scoop up NFL Sunday Ticket from DirecTV, which is currently owned by AT&T. He didn't go into much detail, sort of acknowledged that was out there, but didn't provide much detail. But they already have Monday Night Football. They can now maybe scoop up NFL Sunday Ticket. He did say that the NFL is something that they do plan to be a key part of their future for ESPN going forward. And as I mentioned, Disney Plus, ESPN Plus are going to be a big part of this decentralized entertainment market, where you have YouTube and Facebook and Twitter and all of these companies trying desperately to capture some of this streaming market as cable and more people cut the cord. My wife and I officially cut the cord 2 weeks ago. It's actually been a super easy process. It's a little strange not to flip on the TV and scroll through channels as you normally would, but if Comcast was going to raise our bill all of a sudden after our 2-year promotional thing was up, and we just said, you know what, we're not going to pay an extra $85 for something we rarely watch ever. So that's gone. As a little side note, we're part of now the cord cutting revolution, as they would say. And now I want to close with a little bit of a breakdown of Disney's direct to consumer push outside of ESPN Plus, and that's that Disney Plus as well. But the ESPN Plus numbers are in this direct to consumer business, which they're starting to break now, and as direct to consumer and international results. So those sales jumped 15% to $955 million, but its operating loss grew from $188 million in the year ago period to almost $400 million for that direct to consumer and international business. And this is on top of a huge operating loss last quarter. And as we already talked about, Disney is expecting this operating cost to continue to climb. As we mentioned, the service was launched last April, ESPN Plus. Disney now owns 60% of Hulu, and there's talks that they're in talks with Comcast to buy Comcast stake in Hulu. And Hulu's costs are going up as well, but Hulu is a big streaming business in the United States, and it's actually one of the more fast-growing businesses in that streaming space. Hulu had its paid subscribers reach nearly 27 million this past quarter, which is far below Netflix, 60 million in the U.S., but Hulu added twice as many U.S. subscribers in 2019 so far as Netflix did, and that's kind of a sign that Netflix has really reached almost a saturation point in the United States. That's why its international growth will be so important going forward. And as we've kind of alluded to at the top, this Disney Plus service is going to cost $6.99, which is significantly cheaper than Netflix at the moment. For that top plan is almost $16 a month. So it's not necessarily going to be a substitute for Netflix, especially since it's only going to be that Disney-owned content, which is obviously hugely important. And now Netflix won't have that Disney content, which they have relied on so heavily for the last 5 years, sort of with those Marvel movies and Marvel TV shows and Pixar movies on there as well. So Disney doesn't need to say to users, it's either us or Netflix when it's half the cost. So maybe people, for at least the future, the near future, have both services. So we'll see how that goes as well. But overall, Disney seems positioned really well with its Disney Plus future and its ESPN Plus future and ESPN in general, because as we've talked about on the show before, live sports are kind of driving cable as we know it. Live sports rights are projected to jump from $21 billion in 2019, according to PwC, to $24 billion by 2022, driven by these new bidders. So we'll see how that all works out going forward. And in conclusion of all of this, I kind of just quickly want to look at some more Disney fundamentals as they push out into this streaming future in November. So shares of Disney, and this is as of this morning, shares of Disney over the last 5 years are now up roughly 63%, and that's easily outpacing the larger media market industry, which is up around 26% over the last 5 years. And a huge amount of this Disney growth has come in 2019, and they got that huge boost. The chart is just, if you're looking at a 5-year chart, in the last month and a half, it just shoots directly up after it had that big investors day where they're talking about its Disney Plus future. And then in terms of its valuation picture at the moment, Disney's trading at roughly 19.6 times forward earnings estimates at the moment, which hovers at around the media market's average of 19.1. So its valuation is a little stretched at the moment, but it's not too far out of whack of where it's traded at over the last 5 years. But that huge stock price swing definitely didn't help it going forward, or that huge upwards climb. So that's part of the reason why its valuation picture got a little stretched over the last month or so. And then in terms of its forward price to sales ratio, it's trading at 2.5 at the moment, and that's compared to its industry's 2.3. So its valuation is hardly stretched. That's actually, if you're looking at the forward price to sales chart, that's coming down, and that has a lot to do with its Fox acquisitions, which are set to really help grow the top line over the next year or so. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains.